Okay, Oda, please identify yourself and then fire away. We've got a traveling mic and we've got a standing mic in the back.
And please state whether you're long or short euros.
Oda Aberdeen, the Capital Trust Group. Fred, I agree with your analysis. And to reinforce your point of view, when I look at the Arab oil producers who have tons of money placed in European and American commercial banks, there is a great deal of worry. I think they will feel more secure if they have given this money, or if they give this money to the new IMF bazooka. My question to you is, what sort of financing rate will the IMF pay to make these people commit more money?
We have representatives from the IMF here at the table. I don't know if we could call on them to give us the answer. Probably not. I think it's to be negotiated. So I don't have an answer either. Maybe one of my colleagues does. But I appreciate your comment about the oil producers because you know them so well. But I think a similar calculus applies to China and some of the other big reserve holders. They have complained now for several years about their excessive reliance on the dollar. They don't like the combination of low U.S. yields plus the likelihood of further depreciation of the dollar. And so I would think they too would welcome moving into claims on the IMF. But you're right, the interest rate will be key. I suspect the fund and its members will have that in mind, and keeping in mind the objective of the exercise, which is to provide the global collective good of helping Europe rescue itself and renew the prospects for a prosperous world economy. I suspect a deal can be worked out.
Isn't it strange that we're discussing external loans for a reserve currency area that doesn't have a current account deficit? I'm not sure. I take your point, Fred, that there may be a whip round and the cap is being passed. But what exactly does it achieve to provide external financing when you've got the profound governance problems and the competitiveness problems and the debt overhang problems and the fiscal problems that we've been talking about?
Well, yeah, but Simon, as you well know, one of the big conundrums in this whole debate has been the significance of intra-Eurozone imbalances. Up until the crisis, at least, the Europeans said to the Americans and everybody else, we're not relevant to your discussion of global imbalances because of what you just said, Simon. There's no imbalance of the Eurozone as a whole. But we know that the imbalances within the Eurozone were bigger than the imbalances between the United States and China. I mean, Spain was to Germany as the United States has been to China. And that imbalance is the huge one. And so when you go to the rest of the world, as you well know, you're asking the IMF and its lenders to support not the Eurozone as a whole, but big deficit countries within the Eurozone. Now, as I said, I certainly agree, and I think the Germans will pay huge amounts, and they'll wind up being by far the biggest paymasters, as they have been throughout the history of the European integration exercise. But going to big surplus creditor countries outside in the interest of global stability, I think is not such a bad idea. Vito.
I want to come to the estimate that Italy needs 6%.
Please identify.
Vito Tanzi, former IMF and former Italian government. There was a statement by the first speaker that Italy needs a 6% primary surplus. And for me, it's very difficult to figure out where this figure comes from because, it's the maturity of the debt implies that a large part of the Italian debt still has much lower interest rate. So the marginal rate may be close to 7%. The Italian government taxes the bonds, which you have to remove 12.5%. Italy has an inflation of about 3%, so when you make an adjustment for inflation, you are down to level of marginal debt, which are not very different from the past. And so this is the first point I would like to make. The second point is that this crisis is giving a golden opportunity to the government to make changes which would have been unthinkable 1 or 2 years ago. Pension reform, labor reform, and so forth. So that the country, once you go to this option value of waiting, that is not clear that this reform will be sustained. But if they are sustained, the government could start growing, the Italian government could start growing much faster than it has done in the past. So when you take all these two elements together, I get a much less dramatic picture that has been presented, and I'm talking about Italy. I don't want to comment on the other countries. Thank you.
Yeah. On that slide, I was just commenting that as you raise the risk premium on the debt, you end up raising the requirement of the primary surplus in order to stabilize the debt. So whatever it was before, it rises when you raise the risk premium. So it's just that calculation. And if you raise the risk premium by 5%, then in order to refinance that debt, once it's worked through the whole maturity structure of the debt, yes, once it's worked through 7 or 8 years, you get to those numbers. From the point of view of someone in the bond market, of course, you have to decide, is it going to be a temporary rise in the rate, or is it going to last for a long time? And using the 10-year rate, I think the 10-year Italian government bond's probably around 6.3, 6.4 today. The CDS at 500 basis points is the 5-year CDS. So these are already, expectations that it will last quite a long time in the market. But I fully agree with you. It has to last, and it has to, be there for more than 1 or 2 years. I do think there's a real structural change going on, and I think people have misperceived that in European debt markets. Because if you were a holder of a Greek bond, you really are very soon going to get 15 cents plus 35 in a 30-year bond or a 20-year bond with 3 or 4% interest, and the other 50 will be gone. So if you held that bond and you're a regulated entity where the regulator's got the gun at your back, you got to accept it. And that has big implications for Italy. Now, whether it's 5% or 3% or 7% is unclear, right? It will depend on all the things you described, like will there be big structural reform that will allow growth? Do you have confidence they'll bring the deficit down? All those various things will matter. And it's something you just have to wait and see, right? But going back, if I could say one more thing, excuse me, many things, but on the forest versus the trees, I agree with you, Fred, that there was a forest versus trees argument. I just thought we were on the side of the forest, because that was a tree, right? And that's awfully one big tree, right? We've got a famous individual in Italian finance discussing these issues. We're discussing, is Italy solvent or not, right? With some very famous people who know very well Italian finance. I've never, ever been in a crisis where the politicians and all sorts of people in the society didn't agree it would be awful if it broke apart, right? I've never been in a crisis like that. In Russia, Argentina, all these places we've watched, the politicians always said, we can hold it together. It'd be awful if it fell apart. Russia was a nuclear power, right? Russia was not supposed to default in 98, and it wasn't supposed to break down in a messy way in 91, 92. And yet these things happen, and there's some great papers in economics about why do obviously bad things actually happen in finance. And I would love someone to get up and explain the optimal reason for the numerous hyperinflations we've had around the world, right? It'd be wonderful if they got up and could tell us that. And the answer is there's no optimal reason. Everybody's hurt by hyperinflation. Sometimes it's hard to coordinate decisions. Now, Alessina and Drazen had this wonderful article, which I always think back on, which said the reason hyperinflations happen is that you get a whole bunch of different actors together and they can't decide how you'll divide things up, and it sort of falls into collapse. Your argument is Germany will pay for it all. Maybe. They didn't pay for Greece. We'll see what happens. But this has how many different actors, how many different ways it could fall apart? It's just of such a bigger nature. And then, that's on the policy side. On the market side, you've got $211 trillion of swap contracts out there. And if that market falls apart, regardless of policy, it will fail very fast. And that's the Dornbusch quote. So I kind of feel like that's the forest, but that's the difference we have. Thank you.
Fair enough. Danny?
Thank you. Danny Jiang with the Xinhua News Agency. Thank you for organizing such a timely event. And although both sides have very different views on the outlook of the Eurozone debt crisis and on trees and forests, both sides agree that ECB should provide additional moves to help stabilize the Eurozone debt crisis. So my question is that what specific moves should ECB carry out in what time frame? And what would be the biggest risk involved in further ECB steps? Inflation in the future, moral hazards for the industry, or something else? Thank you.
Jacob?
Well, I think the ECB has already lined up an additional, which I regard as quite likely very substantial additional stimulus measure, which is the next 3-year LTRO at the end of February, which I would actually safely predict to be potentially even larger than the first one. So in that sense, the ECB will be putting its balance sheet to additional use and good and stabilizing use in the near future. I would also echo what Fred said. I think that there is ample room for the ECB, given the inflationary outlook of the euro area, to cut by another, say, 50 basis points in the next 6 months. That will be another way in which they could act. And then if everything else fails, and as we have argued, then we certainly do believe that the ECB will ultimately choose to racket up or expand the security markets program quite dramatically if the alternative is, for instance, I mean, I'm not predicting that, but if that were to come about, a series of failed Italian or Spanish bond auction later this year. So there is ample room for the ECB to act, but I do believe that with the effective blanket bailout of the European banking system, which I regard the 3-year LTRO to be, they have removed quite a big millstone from the entire euro area.
Simon, yeah.
Yeah, my answer would be all of the above in terms of the problems it could generate. But let me just focus on one, which is the moral hazard. Let's say that Fred and Jacob are right. Let's say that the ECB ultimately will do whatever it takes to protect creditors, to remove all the risk from the banking system and from the bondholders and from the associated derivative markets. What has happened if that is the ultimate outcome? What happens to the moral hazard in and around Europe and potentially on a grander scale around the world? I think it just got a lot bigger, and everybody who was legitimately worried about that in previous iterations should be very concerned that this is really where the system ends up.
Just quickly on that, I think we need to be clear that if this actually materializes, what we have is not a politically optimal process, but it is a backdoor euro bond, because that's what the ECB balance sheet is. And in the event that you will require recapitalization of the ECB balance sheet, that's what it is. It's the functional equivalent of a Eurobond.
Antonio? Antonio?
Thank you. Antonio de Lecea, European Union Delegation. You may guess on which side I will put myself.
We count one vote.
But I think that with good reason. And the point is, I mean, Simon and Peter presented the situation, if I may characterize it like that. I mean, there is fear in the market. The market is very big. We don't see any signals that officials are ready to do anything. And that's what I almost quote what I have heard. Therefore, there is also the Greek restructuring case. Therefore, you extrapolate and you get to the results of the forest, the shallow forest picture that you have presented. But I think that you failed to represent first that the assertion that the officials haven't done anything is incorrect, and the extrapolation that they will not do anything is incorrect, as Fred and Jacob put it. First, because there has been an enormous number of measures that have been taken in the past 18 months, be it in terms of governance. We have filled institutional gaps that had taken very long to fill. We have come to terms with much of the fiscal problem and therefore the debt overhang. In Greece, it was 6% of GDP in 16 months. We have, a number of structural reforms have been passed in all those countries that again went far beyond what we had got in the last 15 years. So, I mean, the extrapolation is inaccurate. Therefore, we don't think that the conclusions that you draw, that the market will just continue to believe that nothing is going to be made, at least not in tune with what is needed, is correct. So let me point out one last point, that if you look at the doomsday scenarios, the apocalyptic scenarios that are presented, you can find that most of them are made by actors outside the euro area. And this is where the political economy plays. That if you take into account both the determination of the countries, with whatever limitations, to solve the problems, and the perception and the public opinion, of course an accident may occur, but there is enough ground to support the less gloomy picture that Fred and Jacob presented.
You make some very good points, but on the other hand, what we've seen repeatedly over the past 4 or 5 years is that there is information particularly in the credit default swap spread. And I noticed this when I was at the IMF, actually, and I wrote an article about it that I can send you, that we had many conversations about this or that American bank, about this or that country, and there are always good reasons to think that there could be better outcomes. But if you just look at the numbers, it's what Peter put up at the beginning, and just look at what happens after certain events, certain changes in policy, look at what happens to those spreads. Do they go up? Do they come down? In the situations where they don't come down, the market is telling you something, and it's not a conspiracy. It's not Americans ganging up on you. It's not that we want Europe or the Eurozone to fail. You have to understand that. We made similar points to the Greek government, to the Portuguese government, to the Irish government. We got very similar pushback, frankly, to what we're getting now. And look at what the market was telling them. Look at what they didn't want to hear. Look at what they said about the market and the source of that market information. The market knows what Fred knows. The market hears what Fred is saying. The market knows this political dynamic. Perhaps they don't believe, because they can't be communicated, as Fred says, but they know it can't be communicated, Fred, if they understand your model. They understand the political economy, they understand the constraints on the politicians, and yet the credit default swap spread remains very high. The market is telling you something. You should listen to the market, not obey the market. You should resist the market in many instances like this, but you should pay attention. You should not ignore what the market is telling you.
Well, I can't resist. I would never accuse my good friend and colleague Simon of being a market fundamentalist. But I will recall that in this very same arena, the Eurozone, for the previous 5 to 8 years, the market, the great forward-looking, omnipresent market, treated Greek debt like German debt and charged the exact same interest rate for Greek borrowing as it did for German borrowing. Now, that's not very good evidence that the market knows all and foresees well. Indeed, if we are to have any sympathy for the poor beleaguered Greeks, it's they got a huge mispricing from the markets and were led down a primrose path, which they didn't have to take as much advantage of as they did, but which nevertheless gave them a straightforward market incentive to overspend and overborrow. If we'd been sitting here doing this show 5 years ago, and would have taken a line to that, like which Simon just took, I said, follow what the markets are telling you. Well, you would have said, my friends in Athens, have a party. And they did, and the market was wrong.
Fred, I thought it was well established that the Greeks inaccurately represented the extent of their debt, with the help of some leading market participants, to be sure.
I'm not trying to absolve the Greeks. I'm not trying to absolve the Greeks. I'm just trying to throw a little doubt on the omnipresence of the markets. Yeah.
Ian Talley, Dow Jones. There is the market has apparently been leading policy action, or perhaps policy action has been far delayed. It hadn't got ahead of the market communication. And as you say, Fred, the Germans can't, and the ECB can't communicate the strategy. You should watch what they do. Part of your comprehensive policy response is that the IMF will put together part of this this bazooka, but all of the countries that are supposed to be contributors have consistently said over the past 3 or 4 months, we want to see more action before we contribute. So how can they contribute if they're not going to have clear communication from the Germans?
Yeah, it's a fair question, and of course there's several parts of the answer. One is this whole IMF bazooka has of course been started up by the Europeans themselves. Eurozone's putting 150 billion euro into the pot. Hopefully other Europeans will put another 50 billion. It's kind of an interesting question. You say, well, the Eurozone has all this internal problem, so why is at the same time the Eurozone creditor countries putting 150 to 200 billion euros across the Atlantic the other way into the IMF? Well, of course, because it's to lever the much bigger amount and to get a multiplier effect from their lending that they couldn't get directly through their own institutions. In addition, and I think that's probably the critical part of the answer to your question, a trust in the IMF, not always totally supportable by facts, but usually supported, that the IMF is going to be your best shot at implementing credible and sustainable adjustment programs. In the first phase of the crisis, almost 3 years ago now, the Europeans themselves turned to the fund for help with Greece, Portugal, Ireland. Those are still the only 3 programs, and they're still heavily IMF programs, with the IMF centrally involved in both designing and implementing them. If additional programs are needed for the big debtors, or additional programs for the initial 3, then I think the Europeans are very wise to try to involve the fund for the usual 2 reasons: more effective, more experience on implementing the conditionality, and also able to provide additional financing to supplement what the Europeans themselves have done. So it would be the typical and traditional conditionality-based lending, with a view that having the IMF do it is going to be much more credible to the markets and much more politically sustainable than having the Europeans do it themselves to their own brethren. Now, one can argue that, of course, both ways, but I think the history, including the recent history with the 3 European program countries, pretty well supports that theory. Greece may fail even with the IMF on the other side of the equation. As I said, Greece may be an exception here. It may default, or it already has in Peter's terms. It may have to exit the euro or be kicked out if it doesn't comply. But as Jacob said, and Bill Klein has done, I think, a persuasive paper for us on why Italy is not insolvent, I think that's where the firewall can be built and would be built. But I think those are basically the answers to your questions. Yes.
My name is George Sapari, currently ambassador of Hungary, but former IMF and former deputy governor of the central bank. I think one has to make a difference between the breakup of the Eurozone and defaults. I agree that there can, with your political economy arguments, that Europe will do everything to keep the Eurozone together. That doesn't mean that there cannot be defaults in countries. And there might be defaults even more than what it is now, because even though the 6-packs and the new proposed changes in the fiscal framework will eventually take place, it probably will take longer than the markets would tolerate or have the patience for it. So there might be default, structured default, restructuring of that, which will mean that dwells will disappear, big losses in the country, etc. So my point is that these two things are separate. I think even in front of restructuring, I think the Eurozone will get together, but the cost will be very high, less than if the Eurozone broke up. I agree with that. Second point I wanted to make then, Simon mentioned that why to finance, well, rather that maybe intra-European current account deficits are less of a problem. The problem there is that it triggers capital movements. And when it triggers capital movements, it changes the interest rates, it changes the spreads, etc. So that's why this is a problem. The balance of payments flows within the Eurozone.
Just on the just a historical note on the intra-European current account imbalances. I remember vividly when I was at the IMF, and I'm happy to share in private more details on that. The Europeans' reaction to various Article 4s that discussed current account imbalances within the Eurozone. According to the Europeans, right up to the moment when this crisis broke, those current account imbalances were of were unimportant because it was a currency union for all time. The profoundness, I was in Iceland at a very good conference organized by the IMF at the end of October. And in Iceland, where they have a very good relationship with the IMF and many parts of the program has gone well, somebody said at this conference that we, the Icelanders, this is with reference to the leveraging of the Icelandic society and the size of their banks and how much risk the society took on in that form. Somebody said to the conference that we Icelanders have experienced a period of collective national insanity. And this person got a big round of applause for saying that, right? It's unless and until the Europeans reach a similar realization with regard to the leverage in their societies, we are not going to get out of this.
Sorry. Yeah, I agree fully about the defaults. I think one thing I didn't agree with what was said was that Simon and I were predicting the collapse of the Eurozone and the break apart of it. That's not what we were predicting. We're predicting that it will get very messy. It could just be a lot of defaults. But I think, what is the Eurozone when that happens? It's a zone where Ireland, Portugal, Italy, Greece have very high unemployment, where they've got ongoing chronic fiscal adjustments, where you drive yourself into default, because no one's going to default until they really, really have to. It's going to be an ugly period for many, many years, right? That's the sense in which it may also be a failure. That would not mean the Eurozone breaks up. It would mean there were big bailouts going on, big transfers going on, all the rest. But it is not a good system for the people living in it. And it's a shame, right? They've been forced to have this system. And it's something that will stick with them, and it will be remembered as a period of great austerity, like many periods in the past have in history. And so that's the ramification of having this thing fit onto it. I don't think it's just an optimal currency zone model either, actually. I think it's a whole, you've got to think of the capital flows in the financial markets too, because I think the starting point of this was the wrong debt levels for a regime where you're going to have bankruptcies and no lender of last resort. And you have to think about both of that and the currency union to understand why it's so difficult to go through this adjustment. Thank you.
Jacob, you get the last word.
No, just very quickly. I mean, I would agree with you that and I agree with Peter. I mean, Greece has already defaulted, and I think the concept of what does a structured default mean. I mean, as I said earlier, I'm completely convinced that in the event that Ireland or Portugal cannot go back to the markets at the end of 2013, they'll get more financing from the euro area. In a way, that's a default. Or it's certainly not market priced financing. So I think these two things are quite separate, and you could indeed argue that unless you have that kind of thing, you may end up not being able to hold the euro area together. And just very quickly on Peter's great point about a period remembered about great austerity. No, I think that's true, but I think it is just as likely as this will be a period remembered in the periphery of Europe as essentially the first time in which the labor laws were changed so young people could have a permanent job. They didn't have to take a low-wage temporary job. It will be remembered as a period where people could no longer retire at an unsustainable rate of age of 55. I mean, I think these are just as likely outcomes of this period as the simply high unemployment, economic collapse outcomes.
Okay, we have reached our witching hour. I want to thank very much Peter, Simon, Jacob. Thank all of you for coming. Mike Musa would have enjoyed it. Thank you all.